2025 was a year like no other for shipping, buffeted by US tariffs, trade wars, and geopolitical conflicts. But through it all, markets across most major shipping sectors performed remarkably well. Going into 2026, there seems to not be a let-up, with the US military action in Venezuela within days of the new year. So what does the rest of the coming 12 months have to offer the world of shipping? Hi, it's Marcus Hand, editor of Seatrade Maritime News here, and against that backdrop of geopolitical turmoil, we are taking stock of shipping markets and where they're headed in 2026. Joining us to do this are the team from Maritime Strategies International. You'll be hearing from Adam Kent, Daniel Richards, Will Frey, and Tim Smith from MSI. We'll be discussing the outlook in 2026 for container shipping, dry bulk shipping, tankers, and shipbuilding. Before we drill down into these specific sectors, we'll be starting with a broad macroeconomic outlook from Adam Kent. Welcome back to the podcast, Adam, and if you could just set the scene for our listeners, please.
Hi, Marcus. Thank you for inviting us back for the 6-month update. Yeah, I think since we last spoke back in the middle of 2025, things in the shipping markets have continued probably in the same vein as they did during the first half of 2025. That is, a heightened degree of uncertainty and a degree of market volatility. I think if we sort of drill down on the global economy, I think it was probably actually more resilient last year than we and most others had probably expected. And we actually had to increase our forecasts for global growth in 2025 to 2.7%. From 2.4% midway through last year. And we've also had to push up 2026 marginally to 2.6% year-on-year GDP growth. I think if we look at the US economy, we expect it to maintain a similar pace to expansion in 2026 as it did in 2025 at just over 2% growth. Of course, the impact of trade policy uncertainty has had an impact on the drivers of growth. But at the headline level, some of this has been offset by spending on data centers and the AI economy, with also fiscal policy also likely to support GDP growth during this year. I think China's economy has lost some of the momentum it gained during the first half of 2025. But is still on track to meet the government's sort of 5% growth target for the year. And like the US, the Chinese economy has been more resilient during 2025 than we expected it, especially given views of the market during the sort of peak trade tensions with the US in the first half of 2025. But the Chinese consumer and property sectors, I would say, remain in the same poor health now as when we started 2025. So that's something to be mindful of as we move into 2026 and beyond. And although we did see some of the loss of volumes from China's exports to the US due to tariffs, I would say that China has been successful in diverting some of these exports to alternative trading partners, especially places like Africa and Latin America. In contrast to China and the US, I would say growth in Europe remained weak during 2025 and will do so in 2026, with the industrial sector remaining under pressure alongside some weakening labour markets. If we're looking for bright spots, India remains sort of the brightest of them all, I would say, with growth around 6% last year. And a number of the Southeast Asian economies have performed well during 2025. Malaysia, Vietnam, Indonesia are sort of countries to mention of note. So I think if we start looking more from a shipping macro perspective, cargo growth last year was actually the lowest it's been since 2022 at around 1.8% seaborne cargo growth, whereas the fleet grew by 4%. But as ever, increasing ton miles and further fleet inefficiencies have continued to support the markets more than the sort of headline fundamentals would naturally suggest. During the first half of 2025, tariffs were, of course, the big news. They have become a little bit more stable over the back end of 2025, though, of course, the legal basis for some of the US tariffs are still being discussed in the Supreme Court. And the decision on that has to be made by June. So we're watching that space as we move forward during 2026. Most countries are now dealing with reciprocal tariffs of around 10 to 20%. And China is facing the sort of pre-2025 tariffs plus an additional 20% on top of that, which is down from around 30% in Q3. So things aren't as bad as perhaps they did look when we spoke just over 6 months ago. What we have seen over the course of the second half of 2025 as well has been a lot of pauses and delays. And these themselves have been sort of giving a lift to the shipping markets, but again have been pushing on a degree of uncertainty as we move forward into 2026. Of course, we had the USTR 301, which in November we saw the year-long pause to port fees and tariffs and the reciprocal Chinese tariffs. So we're sort of waiting to see how that one pans out. The IMO, the MEPC meeting in October, pushed back the adoption of the net zero framework for another year. So again, another pause, which again is impacting, I think, the markets and certainly contracting behaviour during 2026. And of course, we've also seen the pause in attacks from the Houthis on the Red Sea, with the ceasefire continuing to hold. And we are now starting to see a few more vessels going through the Red Sea and the Suez Canal, and certainly a lot more owners talking about sending their vessels back through the Red Sea over the course of this year. Generally, for time charter rates, I would say we saw them soften during 2025 versus 2024. Containers continues to defy gravity, and we're still seeing high levels for container TC rates. Tankers have also benefited over the course of the second half of last year, with a lot more oil now on the water. And as we move into 2026, we do expect to see same sorts of volumes of seaborne cargo trade, around 2%, world fleet growth at around 4%. So there will be fundamental pressures on the fundamental side, especially if we start seeing more vessels going back through the Red Sea and the Suez Canal, which will sort of increase the efficiency of the fleet to a degree which will have to have an impact on time charter rates. So we're coming into 2026 with a lot of the same reoccurring themes, but a lot of them continue to move, and we keep a watchful eye here at MSI on how these will impact the fundamentals and structural changes within the markets as we go on into 2026 and beyond.
Thank you, Adam. There's a sort of theme there, almost of like disruption, defying the fundamentals a little bit, and whether that will continue going into 2026. Thanks for setting the scene there, and we'll now drill down into the individual sectors. If you're enjoying the Seatrade Maritime podcast, make sure you never miss an episode by subscribing on the app of your choice. First, we shall be turning our attention to the container shipping market with Daniel Richards. And welcome back to the podcast, Daniel.
Hi, Marcus. Thanks for having me back on.
Oh, great. Thank you for taking the time to talk to our listeners. And could you give our listeners an overview of the container shipping market in 2025?
I think if you look at the year as a whole, it was a weaker market than what you saw in 2024 and parts of 2023. But still, on balance, liner companies in particular managed to stave off a return to unprofitability or loss making, and managed to hold off freight rates broadly from the lows you saw just before the Houthi attacks began at the end of 2023. But it was a year on the whole where the effects of cumulative supply growth did begin to bite, and over the course of the year, on average, markets did weaken. So if you look at a measure of sort of global average freight rates, that's published by Container Trade Statistics, the latest data point we have from October, that was around 20% lower year over year. compared to October 2024, but still about 10% higher than it was towards the end of 2023. If you look at spot rates, what happened in the course of the year is that things deteriorated over sort of the first 3 to 4 months of the year before that sort of blizzard of tariff announcements injected volatility into the US trades. You saw a diversion of Chinese cargoes that led to higher volumes on some of the Asia, Europe, and emerging market routes. But once you got through the summer, when freight rates had temporarily increased, they then began to soften into the second half of the year, into Q4. It felt a little bit like we were returning to a sort of a freight rate war situation, with carriers failing to get freight rate increase to stick and signs that were beginning to undercut each other. But as we close 2025 and start 2026, rates have been on the up again as we approach the kind of Lunar New Year close downs in China. So it's been a relatively volatile year, not the levels of volatility you saw during COVID and during that initial post-Houthi attack run in the first half of 2024. But it is a market that has weakened compared to where it was last year. That's on the liner side. In the sort of charter market, asset market side, it's a very different picture. Charter rates have held up incredibly firmly, far above long-term averages. It's a similar picture for second-hand asset values. And for the moment, that isn't a market that's showing really any signs of slowing.
So actually a better time to be an owner than perhaps an operator.
Absolutely. And that seems very likely to continue in 2026 at least.
Right. Adam mentioned before about this tentative return we're seeing of some to the Suez Canal and Red Sea transit. So do you have any sort of feeling for when we might see a full return by container lines to that?
I think it's very uncertain still. There's clearly a lot of uncertainty about how durable the ceasefire will remain between Israel and Hamas, whether further regional sort of conflagrations could bring attacks on the Red Sea back into the picture. But we are beginning to see some of the major lines seemingly lay the ground for return. So you've seen Maersk and CMA CGM put large container ships back through the Red Sea in recent weeks. You've begun to see lines restructure some of their services so that you have Red Sea transits happening on some of the backhaul sailings. CMA CGM now have a few routes where they're going through the Red Sea on both head haul and backhaul routes. But for the moment, there isn't firm evidence there's going to be a mass return imminently. Only the Premier Alliance have kind of announced their reconfigured 2026 network so far. That, for the moment, still has Cape of Good Hope routings. We'll probably hear from the Ocean Alliance in the next few weeks. So I think that you will begin to see a larger increase in sailings sort of from Q2 onwards. And I think by this time next year, there'll certainly be a much larger proportion of vessels going through the Red Sea. But it really does remain uncertain and very kind of susceptible to reversal.
I mean, obviously from a supply and demand sort of point of view, it's perhaps not something lines are going to be wanting to rush to do, really, is it? How does that balance look, sort of, if you look both at the current situation and if you then see a return, a large-scale return to the Red Sea and Suez Canal?
Yeah, so I think if you take the kind of plain vanilla or headline demand-supply fundamentals, what marked 2025 out was, yes, it was a continued situation of elevated fleet growth. So the fleet grew by about 7% year over year last year. But somewhat against expectations, it was also a very strong year for containerized trade growth. So we think that when all the numbers get sort of published and finalized, you'll see demand growth of around 5% for 2025 as a whole. And that reflects a number of different factors. That's the broad resilience of the global economy. But I think the major feature of the sort of the container trade landscape that has emerged is just how competitive Chinese exporters have become. They've managed to withstand a major rise in US tariffs, some loss of sort of labor cost competitiveness versus other emerging markets. And in a wide range of products, Chinese exporters have continued to maintain or even grow market share. And you have this situation where China's domestic economy, as Adam alluded to earlier, remains very much underpowered. You don't have the purchasing power there to absorb all the goods that China's manufacturing sector is producing. And that surplus of goods is finding its way to a range of other markets. So that's partly Europe, but in particular, it's emerging markets. Africa saw containerized imports from the Far East grow by 30 to 40% for much of the last year. So I think if we look at the demand outlook for 2026, can this continue? I think that for the moment, the Chinese economy is going to be dependent on exports and on investment in manufacturing. And for the moment, we're not seeing major retaliations in terms of trade policy apart from the US. There's murmurings of this beginning to emerge in Europe, but whether that will actually attack or end up targeting a broad array of goods that tend to be transported in containers versus sort of more strategic products like sort of semiconductors, which aren't so important from a volume perspective, that remains to be seen. So we think that the demand side will slow in 2026. That's partly just reflecting a strong point of comparison. We think that there'll be some sort of factory closures in China as some of those businesses remain unprofitable. But overall, I think that sort of China boost to trade is going to broadly continue next year, but just as a slower pace. What will also see a slower pace is the fleet. So it's going to be a temporary lull in fleet growth in 2026. We think fleet growth will come in at about 3.5% this year versus just over 2% for trade growth. There was a brief respite from new build contracting in 2023, which explains why deliveries are going to slow this year. So it's going to be a brief respite on the supply side, but that will very much reverse when we get into 2027 to 28. So broadly speaking, it should be a year where there'll be an additional erosion in demand-supply balance for the industry, but not necessarily a catastrophic one. As you've alluded to, though, the Red Sea situation is hanging over this. And if you were to see a full return to Red Sea sailings over the course of this year, that would add additional pressure onto industry demand-supply balances. So we've done an exercise where if you look at the services that are currently going around the Cape of Good Hope that might normally go through the Red Sea, if you were to reconfigure and design those services to have Red Sea routing instead, making adjustments for like port calls, you'd probably add or drop with that different geography. We think that would release around 1.75 million TEU of vessels. That's about 5 to 6% of the fleet. So that's a bit less than the sort of that 10% number that you often see quoted, but it is still potentially a substantial additional volume of tonnage you need to absorb at a time we think where wider demand supply balances will weaken. So it's going to be a relatively balanced year once again for demand supply, but still with the leisure leaning towards higher supply growth.
Okay, so hopefully not that sort of collapse that I think I have seen some predictions of. Now, you mentioned the ordering side there. That seems to have been the unstoppable bit for container shipping. Is that going to sort of tail off in 2026?
I think we presumed it would have to tail off in 2025, but that was then a new record-breaking year for new build contracting. So at the risk of being wrong again, yes, it should slow down this year, especially for contracting of large vessels. There should still be a healthy volume of smaller container ships being ordered. That fleet is aging. I think liner companies are waking up to the fact that the available ships at the smaller end of the fleet aren't necessarily there, and they're currently having to pay extravagant sums in the charter market to get that tonnage. So I think that there will be continued order of smaller vessels, especially to kind of renew that fleet, to potentially start exploring alternative propulsion where there's been limited uptake so far with smaller vessels. So probably not a collapse in new build contracting volumes in 2026, but I'd be very surprised if you saw anything near a repeat of what we've seen in the past 2 years there.
Yeah, has become a very difficult one to sort of forecast, that one. Thank you, Daniel. There's obviously a lot going on in container shipping. I'd like to move on to the dry bulk market with Will Frey. Will, welcome back to the podcast.
Hi, Marcus. Nice to speak to you again.
Great. Thanks for taking the time to talk to us today. And could you first just sort of give us a look back at the dry bulk market in 2025?
Yeah, I think the resilience is another theme for dry bulk. Resilience to various disruptive factors, tariffs, USTR, etc. But on the fundamental basis, resilience to the fact that the fleet grew by 3% over the year, yet demand actually expanded only by 0.5% demand in terms of the tons traded. So it's quite remarkable that dry bulk earnings only fell by around 10% year on year. So they were lower. So this sort of disparity between trade growth and higher supply growth certainly had an impact on suppressing rates. But certainly towards the end of the year, rates were much stronger than those sort of fundamental trends might have suggested. It's been another year where the changes to trading patterns have supported the market. One way to look at this is obviously look at the effect of distances and speeds. And if we combine those together for average voyage times, they increased by 4% in the Capesize sector, slightly less in the sub-Capesize sectors. And that was due to a rebalancing of trade routes where particularly weak coal trade around the Pacific was then offset by higher trade coming out of the Atlantic into the Pacific. One key point being bauxite markets, where Guinean bauxite shipments into China, Guinean bauxite exports expanded by over 20% year on year, and that was a huge factor in supporting that increase in distances. And aligned to that was the higher port waiting times to load bauxite. So this kind of redistribution of trade then helped support the freight market to levels that were much higher than the underlying trade and fleet growth would have suggested. So where we stand now is that the market started the year on a better footing than last year. So I think that there's a little bit more positivity sewn into people's expectations.
Okay, so you see that as a more positive start to the year. Do you see a sort of seasonal downturn that we tend to see in the approach to Chinese New Year, or how do you see it going?
Yeah, I think that is what we would expect this year. There's no particular drivers that would derail that seasonality, and we are expecting earnings to soften. We are already seeing particularly sub-Capesize benchmarks starting to come off their recent peaks. And I think the one segment of the fleet we are most, let's say, cautious about in the near term is the Panamax market. Not only is coal trade continuing to fall, there is a very significant amount of Panamax tonnage being delivered this year, and often you see a Q1 spike in deliveries, as we'll see probably this month. So to put that into context, we look at Panamax vessels between 70 and 120,000 deadweight. Over the past 5 or 6 years, deliveries been around 10 million deadweight, but in 2026, there's expected to be 15, 16 million deadweight delivered. So it's quite a big uptick this year. And interestingly, if you look at the ratio between Capesize spot earnings and Panamax spot earnings, that Cape-Panamax ratio, that's now firmly over 2. So when this happens, when that ratio expands widely, then you'll see stems splitting, you'll see shipments being moved into Panamax vessels. And that actually was a theme that was happening through 2025 as well already, because of this weaker coal trade, was that differential widened, and we did see the remaining coal trade being taken more by Panamax ships, a higher share in Panamax ships, whereas Capesizes were moving more into iron ore and bauxite trade. So if this Panamax segment comes under pressure, then we expect that to happen certainly during Q1. And meanwhile, there will be disruptions to iron ore exports, and that will see Capesize markets decline as well.
So it's going to depend a bit by ship sector. I mean, if you look further out to the remainder of the year, what do you sort of see as the demand drivers for dry bulk shipping?
Yeah, I think we're slightly more positive than we have been. The main theme that is on people's minds in the dry bulk sector is how much the impact of Simandou will have on the market. This 120 million ton capacity iron ore mining coming out of West Africa. And our expectations are it's going to take some time for this to ramp up. So it's not really going to have a hugely positive impact on the market this year. We'll start to have an impact later in the year. But the difficulty with this is well, actually, it's not only West Africa, but also Brazil's bringing out new capacity this year as well. So there's a lot of new iron ore capacity coming to the market. So the question then is where that's going to go, because China's property markets remain weak. We don't yet see signals of any kind of stimulus just yet on infrastructure growth. So we think that Chinese steel production will remain under pressure this year. So then to absorb this new iron ore export capacity, then we'd need to see either a step change in China's stockpiling efforts or a sharp reduction in domestic output. And so we're actually now slightly, we think that Chinese domestic production will be cut, and actually will be cut by around 30% over the next 3 years. So a gradual reduction in China's iron ore production. And that'll make room for these imports. But overall, there's not going to be huge growth this year. So we have iron ore trade rising by 1.5% in 2026. So it's not going to be a massive driver. Meanwhile, coal trade is still under pressure and will likely fall. Bauxite is an interesting one in that last year had such huge growth that China is now importing more bauxite than it can consume based on the cap to aluminium production in China, and that cap remains in place. Then it's very difficult to see them importing a lot more bauxite unless they again build strategic stockpiles in bauxite, and those stockpiles are rising at the moment. They're still below historical maximum, so there's still potential maybe for more bauxite to be traded, but not to the same extent incrementally as there was last year. So that's not going to be a big incremental driver for trade growth this year. We're slightly more positive on grains out of Brazil, and now there is some agreement between the US and China to see some grains moving along that route. Meanwhile, there will be continued support from minor bulks, from fertilizers, from steels around Asia, out of China, exporting excess production, and other construction materials into Southeast Asia. So we think that overall trade growth will be stronger this year than it was last year. So over 1% this year versus 5% last year. So it is certainly better, but that's still not hugely positive given the
Okay, so not a hugely positive picture, but not too bad. What about the supply side? Overall, I think dry bulk has seen relatively little new build ordering compared to most other sectors.
Yeah. I think I've mentioned Panamax supply dynamics being a threat to the market this year, and we have the highest year for deliveries, around 40 million deadweight tons expected since 2020. So in terms of near-term supply threats, then we do think that overall that there will be a sort of more supply pressure on the market this year, much as we saw in 2025. We saw a 10% downturn in freight markets overall for the year. We expect further declines in 2026. Beyond that, the order book is still quite low, and it's difficult to see a large amount of ordering if freight markets should then decline this year. We've got very high newbuild prices. We are expecting newbuild prices to come off a bit. Adam will talk about that later. And when that starts to happen, then perhaps that would leave owners still pulling back from ordering for a while yet. And as Dan mentioned, for container ships, then the uncertainty related to the IMO net zero framework, meaning that perhaps ordering still gets delayed for many owners. So we are expecting ordering to be quite weak in 2026. So that overall will help the market in 2-3 years' time. So when Simandou ramps up, when deliveries start to really fall, then we are maybe more positive for the outlook beyond 26, 27. But until that time, we'd say that we're expecting freight markets to continue to decline from the recent peaks.
Okay, so hardly a banner sort of year for dry bulk, but looking a bit better going further out. Thank you, Will. Now I'd like to welcome Tim Smith back to the podcast to talk about what has been happening in the tanker market.
Hi, Marcus. Thank you very much. Very good to be back.
Great, and thanks for taking the time to talk to our listeners. And perhaps you could just, as we have done with the other sectors, give us a review of the tanker market in 2025.
Yeah, so 2025, the market was coming into the year on the back of some lower earnings across 2024, but conditions were still relatively good, if not spectacular, for both the crude and product sectors in terms of vessel earnings. Going into Q2, of course, we saw a lot of volatility. We've spoken about the tariff situation coming into play. That didn't have as big an effect on the tanker sector, and indeed, of course, we've discussed on the wider macroeconomy as perhaps some feared at the time. I think during Q2, what we saw of more influence for tankers was the decision by OPEC Plus to start to ramp up production. And this was announced initially in April, and subsequently we saw consecutive monthly production increase announcements of significant volumes through the course of Q2 and into the second half of 2025. And also the group followed through with this. So we saw oil production increasing from OPEC Plus by a very strong amount, perhaps around 2 million barrels per day across the second half of the year. And that really injected some upside into trade volumes particularly for the crude sector. Alongside this, America's production increasing as well. So we saw longer haul trade coming out of Latin America in particular, from Brazil and Guyana, for example. And that all added to the underlying fundamentals, the strength in the market underpinning the sector in 2025. And of course, on top of that, we saw ongoing geopolitical disruption and uncertainty through the course of the year. We saw sanctions activity increasing, so the US became much more active in terms of sanctioning both vessels and oil infrastructure. We saw Rosneft and Lukoil sanctioned by the US in Q4. We saw other activity restraining Iranian crude imports, for example, into China. And so all this, alongside increasing sanctions on the wider fleet, tightened conditions both from a demand and supply perspective. And in Q4, we really saw this manifest in terms of very strong conditions for the tanker sector, particularly larger crude tankers on the spot side. And VLCCs in Q4 2025 were earning north of $100,000 a day, as we saw both increases of oil on water and delays and disruption related to sanctions activity and other elements. We've mentioned USTR and the China port fees issue as well, coming into play briefly during that time as well. So Q4 was a very strong period for the crude tanker sector. We have actually in the early days of 2026 seen those conditions come off. For product tankers, conditions were not as strong. That market didn't see the increase in trade volumes that crude did. And actually, MSI expects product tanker trade, seaborne trade volumes to have contracted, and not by a huge amount in 2025. And listeners can sort of see more detail on that in our MSI Horizon platform and quarterly market reports on the sector. But it did show in terms of product tanker earnings, which really didn't see the upside that crude tanker markets did in Q4. So we're really in a market where supply-demand fundamentals were constructive from an owner's perspective in terms of earnings. The other element, I guess, that's worth mentioning on the fleet side is that there are still very few deliveries through 2025. So you also had that kind of supportive element in terms of limited additional capacity coming into the market last year. So the tanker sector comes into 2026 on a very strong footing. And also, of course, we are seeing those geopolitical elements, that kind of turbulence continue with US actions in and around Venezuela through December and, of course, into January 2026.
Yeah, you say the market's coming in on a strong footing there. How do you see it sort of progressing as the year goes on? There was a lot of moving parts involved in 2025 based on what you described.
Yeah, and I think front and centre on everyone's minds, certainly at the time of this recording in early January, is the geopolitical situation. I mentioned US actions around Venezuela. Through December, there were a number of vessels, VLCCs, seized by the US, and in early January, they captured another one, formerly known as Bella 1, renamed Marinera, Again, we track this kind of activity on our platform, MSI Seascape, which looks at vessel movements and analysis around the world across all sectors. Those moving parts on a geopolitical perspective don't appear to be slowing down, and I think we're seeing more and more fracturing of geopolitical norms, certainly a more interventionist policy from the US, which adds to other ongoing areas of turmoil. Of course, we've got Russia, Ukraine, and that in itself has a number of elements which will kick in or continue in 2026, including the EU ban on refined product imports from Russia-derived crude, which will have some effect of reshaping product trade volumes this year. And we also saw, perhaps less well publicized through Q4 25, Ukrainian attacks on Russian vessels in the Mediterranean region as well. So the tanker sector is literally under attack in terms of vessels being seized or attacked. We've got other areas such as Iran as well, which is also seeing some protests and has been subject to US measures and sanctions to try and suppress its oil exports. So those moving parts continue. And I think let's look at it purely from the perspective of the tanker market. These typically tend to be positive elements in driving up, of course, uncertainty, energy security, and typically tanker earnings when we see more and more geopolitical turmoil. So that continues to be layered on top of what we expect to be quite a positive picture in terms of trade volumes in 2026 as a consequence of still relatively high production. And I should say, from a kind of oil market fundamentals picture, the oil market is oversupplied. Crude production is high relative to quite subdued oil demand growth. So we're seeing that buildup of stockpiling as well in 2026. That potentially has some pitfalls for the market, for the tanker sector later on, if conditions become oversupplied and we start to see a pullback in production. We've seen that kind of thing happen before in for example, 2014-15, and that can have a negative effect further out. And also we're going to start to see deliveries increasing for tankers this year, and they're going to stay high through the next few years because we have seen very high levels of contracting in the market, certainly in 2024, but also 2025. Latter half of 25, we saw much stronger ordering of larger crude tankers, Suezmaxes, and particular VLCCs. And so all of that new tonnage is going to come through into the market and start to add a bit more of that fleet side pressure on earnings conditions that hasn't been there for a few years.
So you've got some quite sort of potentially positive factors from the geopolitical disruption, but the actual demand and supply picture does sound like it's going to sort of not be as good as the year goes forwards.
We think it will be pretty positive in 26, and we're talking perhaps a little bit further out in terms of 27, 28, how things may swing around. But of course, there's a lot of uncertainty within that. We've mentioned Suez Canal. That adds another layer of support for the market, which could change over time. We started to see a bit more traffic going through there on the product tanker side more recently. So yeah, there's a lot of these kind of conditional factors which could move in different directions to potentially support the market. We're positive in the near term, but yeah, a bit more cautious going further out.
Okay, fair enough. I think I just want to come back to one thing you mentioned earlier, and that's really on the tanker seizures that we've seen in the last few days, and the dark fleet, which has been, quite a sort of a big feature of the tanker market over the last few years. Is this going to change how that's been working?
It certainly changes the dynamic. I think the fact that the US has started seizing tankers linked with Russia is a new development. This has obviously been a major factor since the start of the Russia-Ukraine war. I don't see it changing in terms of the fundamental dynamic, which is that Russia or the ship owners that are servicing Russian crude and other crude from Iran and also Venezuela will require tonnage. It's a growing component of the fleet. The sanctioned component of the fleet has also grown significantly. So actually, when we look at some of the major tanker segments, so for example, Aframaxes, uncoated Aframaxes, which are the sort of workhorse of the crude sector, if you like, versatile, the smallest major element in the crude tanker market, about a third of that fleet is under sanction, and significant proportions of the Suezmax and VLCC fleets are as well. So these factors are rising. I think it will continue to be an unknown factor in the market going forward. There will continue to be demand for older tonnage. We're seeing very little scrapping of tankers happening because older tonnage is just moving into the dark fleet. And so there's more and more restrictions on vessels available for charter from more kind of conventional chartering agents, and it poses more and more restrictions on the fleet. So I think the US-Venezuela situation does change the dynamic, but the kind of dark fleet remains both a risk to the market, because obviously there's a huge risk in terms of these vessels that are badly maintained, inspected, and so on, seeing major incidents on sea, but also it continues to pose a risk in the sense that there becomes less and less tonnage available for kind of conventional charterers as the tanker fleet is aging rapidly now.
Okay, so yet another sort of a factor in that whole mix that we were discussing. It's going to be really interesting to come back in 6 months' time and see where all this has gone. Thank you, Tim, for taking the time. And that kind of segues us nicely into the final part of this podcast. And I'd like to come back to Adam Kent to talk about what's been happening in the shipbuilding market. Adam, could you give us an overview of that market, the shipbuilding market in 2025?
Yes, of course, Market. Shipbuilding remains another interesting part of the market. And last year, 2025, was actually what I would say was the fifth year of a sustained ordering boom. We saw over 90 million gross tons of vessels ordered last year. And as we've heard, once more, this was sort of dominated by the container ship sector, which accounted for nearly half of that 90 million GT total. Contracts last year actually pushed up the order book to 300 million gross tons. That's now the third largest order book ever, only surpassed by 2007 and 2008 at sort of the end of those glorious super boom years. What that does mean is that we're sort of set to see deliveries ramp up this year to around 80 million GT, and will almost top out at 100 million GT next year in 2027. I guess the other interesting and continued factor in the shipbuilding market is the expanding shipyard capacity, both expansions of existing facilities, but also a number of new sort of greenfield yards that have come out of the woodwork over the course of the last 12 months, trying to sort of take advantage of the current ordering glut and the sort of profitability in shipbuilding, primarily focused in China. And I guess the sort of the yard of note in China that sort of has come out of sort of mothball condition is Hengli. 2023 delivered 0 vessels, and by next year we'll be delivering something in the order of 7 million GT. So a huge ramp up in production at Hengli, which of course was the old STX Stallion yard that went bankrupt last decade. And what we've also started to see a lot more of is your sort of traditional yards now exploring new ventures elsewhere in lower cost countries, trying to help keep prices down for sort of mainstream merchant vessels, whether that be new yards in Philippines or Vietnam, while at the same time focusing their sort of top tier yards, their domestic yards, on higher end sophisticated vessels or even naval vessels. Of course, this was a tactic that we saw the yards deploy during those sort of 2000, the first decade and into the second decade of this century, to some success. for some, but not very successful for others, shall we say. So it's been a yet again another interesting year of developments within shipbuilding, and shipyard capacity does remain very elastic.
Some very big numbers in there, and echoes of 2007, 2008, which perhaps if you do remember those times didn't end very well, did it? Coming into 2026, what is sort of the expectations in terms of new building orders? Are we going to see a continuation of those kind of numbers you talked about in the last year?
Yeah, I mean, it's difficult to see contracting volumes continuing at these levels for yet another year in containers or across the board. So we do expect to see contracting to drop this year by around 40% year on year versus last year, to around 50 million GT, which in itself is still quite an impressive total. Containers will once more make up a large part of that contracting volume, although it is a lower total, that has to be said, and will make up around a third, we think, of all contracting over the course of 2026. And as Dan has alluded to also, that there will be this continued move in a relative term towards smaller vessels rather than the sort of the 20,000 TEU vessels and above. We do expect 2026 to be another fallow year for ordering for the gas carrier market, the chemical tanker market, and the car carrier market. But that was something that we also saw in 2025 with orders for those really ramping up in the 2022 to 2024 years. As we've also heard, oil tankers and dry bulk volumes will be steady, but not at the levels that we have seen in the last couple of years. And we really do think that we do need some orders for tankers and bulkers, given the age profile of the fleets. But we really think the ramp up in these sectors will come towards the back end of this decade and not in the next couple of years. In 2027, just looking beyond the current year, we do see this as the sort of nadir in the current ordering cycle. And we expect to see around 40 million GT ordered next year. So ordering will still be there. The problem is, I think, from a new building price perspective, that we will have an increasing number of yards, an increasing number of yard capacity competing for fewer orders, which usually means one thing, is that the yards then have to reduce new building prices to try and attract more orders. And we wait to see which yards will potentially win the battle when there's a lot fewer orders being placed by the world's ship owners.
So potentially good news if you're an owner and you are looking to order, but not perhaps so good if you've just opened a new shipyard. One of the other factors, and I think it was mentioned earlier in the episode, is the delay to the IMO net zero framework. Is that going to both impact the willingness to order, and also will we see people revising their orders to perhaps reduce them being dual fueled or whatever?
Yeah, I mean, I do think that obviously it is introducing yet more uncertainty. The fact, as I said, I think earlier in the episode, that it's a delay by at least 1 year, and whether it will be 1 year, 2 years, or more, we've yet to see, and we will see. But we will potentially get more visibility on that as the year pans out. I do think it will have an impact on ordering volume, given this uncertainty, and it will also put doubt in owners' minds when and if they order vessels, whether they order dual fuel vessels, the dual fuel technologies that they employ, or whether they just go for a dual fuel ready alternative, which of course is something of a halfway house, which costs a lot less than going full dual fuel engine capabilities. I do think that we will also see a lot more onus on energy saving technologies, because of course that can get you some of the way to decarbonising, using less fuels, whilst at the same time being a lot more profitable for the vessels and the owners, and a lot more attractive for the charterers. So I do think that we will see perhaps a further step up in those energy saving technologies or changes in hull forms as we move forward over the course of 2026 as something of a mitigant to not knowing whether to go for fuel all out dual fuel engine and dual fuel technologies.
Okay, so definitely some degree of impact there. I think one of the things that the shipbuilding market, you look at it, China has become very, very dominant, but we are also seeing these developments, the Korean yards looking into the US, India, Japan looking to revitalize its industry. Can anyone really challenge China?
I think the short answer is no, but I think generally China is here certainly for the next 20 years, I would say, to be the dominant shipbuilder globally. As long as there isn't sort of strong political incentives to persuade or force owners to ordering elsewhere. Of course, the US TR 301 sort of started leaning that way, and obviously that could obviously ramp up given the sorts of events that we have been seeing coming out of places like the US over the course of the last 12 months, given the current policies that seem to be coming thick and fast. I think just the fact that China just now has this sort of wealth of experience, the track record, the supply chains, the infrastructure, the designs backed by finance, alongside what is more expensive but still remains a cheaper labour force than other sort of historical powerhouses of shipbuilding like Japan and like Korea. And it still remains a central prop to sort of both centralized, regional, and local governments in terms of employing vast numbers of people, developing the labour force, and adding to the economy. So I really do think China is here to stay. That's not to say that we don't think that some of the market share that China currently has won't be eaten into by some of the other sort of Japanese or Koreans, but probably more like the Indian shipyards or Vietnamese shipyards, which are sort of now the governments are identifying shipbuilding as a strategic industry, whilst at the same time, some of the Koreans and the Japanese, as I sort of mentioned previously, are also looking to start up or re-energize some of the yards that they have outside of their sort of domestic jurisdictions. And only over the course of the last couple of weeks, we've just had the Japanese government come out with its shipbuilding industry revitalization roadmap, which the Japanese government is looking to double Japanese shipyard capacity by 2035. And I think the success of that will very much be whether the Japanese can attract skilled workers back into shipbuilding in an industry that has, over the course of the last 10 years in Japan, really sort of declined from being a very sort of dominant number 2, number 3 player to really sort of playing in any. I think it attracted around 10% of all orders last year. So I think there really has to be a heart and minds type campaign to go alongside money and technology in Japan if it really is to start to sort of try and achieve some of the goals that the government has now set out.
Thank you, Adam. Some interesting developments to keep track of going forward. And I think just to wrap this up, there are, when you look across shipping as a whole, there's certainly a lot of factors to take into consideration as to where things are headed over the next 12 months, and we'll be following all these markets on seatrade-maritime.com. I'd like to thank Adam, Daniel, Will, and Tim for their valuable insights today.
Thank you, Marcus.
Great. Thank you. And we look forward to returning to look at the markets with the team from MSI in mid-2026.